Nigeria's first Sukuk bond of 100 billion naira which was issued on September 26, 2017, is set to mature on September 26, 2024. This is according to the 2023 Annual Activities Report of the Financial Markets Department of the Central Bank of Nigeria. Welcome to Business Point, where we x-ray the Nigerian economy and the government policies. I am your host, Kikelomo Okere. Nigeria has been paying rental at a rate of 16.47% on this bond every March 26 and September 26 as a form of debt service before its maturity date. Following the auction of the bond in 2017, the Debt Management Office announced that its offer for the 100 billion naira, that is 7 years debugged Sukuk offer, was oversubscribed. Investors across a broad spectrum comprising pension fund, banks, fund managers, and institutional and retail investors subscribed to the offer. The offer attracted a total subscription of 105.878 billion naira. However, 100 billion naira, the exact amount offered, was allotted. Over 1,000 retail investors from across the nation accounted for 4% of the total subscription, according to the agency in charge of the country's debt. In 2023, 11 banks incurred a total of 575.168 billion naira in taxes, marking a significant of 175% increase compared to 209.608 billion naira incurred in 2022. Out of the total of 440.305 billion naira was specifically for the taxable year, that is 2023. The rise in tax expenses can be attributed to a substantial increase in pre-tax profit recorded by these banks. The banks collectively made 3.722 trillion naira in pre-tax profit, driven by a rise in the net interest income, non-interest income, and foreign exchange revaluation gain. This pre-tax profit figure represents an impressive 197% increase from the 1.255 trillion naira reported in 2022. These banks are Access Bank Holding, First Bank Nigeria Limited, FCMB, Fidelity, GTCO, Jaiz Bank, Stanbic IBTC, Sterling Bank, UBA, Wema Bank, and Zenith Bank. Considering the Nigerian government's recent plan to implement a 50% tax on the profits realized from the foreign exchange revaluation in 2023, aimed at funding an increase in workers' minimum wage, these banks' tax burden are expected to rise further. This new tax policy could impact their profitability and capital adequacy, especially if the banks had planned to use this foreign exchange gain as a counter-cyclical buffer against currency fluctuation as directed by the Central Bank of Nigeria. In 2023, the bank reported a combined post-tax profit of 3.156 trillion naira, which is a substantial 201% increase from the 1,048 trillion naira recorded in 2022. Access Holding reported a pre-tax profit of 729.001 billion naira in 2023 and incurred a tax burden of 109.677 billion naira, marking a 642% year-on-year increase. Consequently, profits after tax stood at 619.324 billion naira. GTCO incurred an income tax expenses of 69.654 billion naira in 2023, with 73.894 billion naira for the current year and deferred tax assets of 4.243 billion naira. First Bank of Nigeria Holding PLC incurred an income tax expenses of 48.393 billion naira in 2023 from a pre-tax profit of 351 billion naira, the lowest among the other Tier 1 banks. This figure highlights the significant tax liability incurred by Nigerian banks based on the rise in the pre-tax profits driven in part of foreign exchange related gains. The proposed 50% tax on realized foreign exchange gain presents a potential challenge, impacting their profitability, financial health, return on shareholders, and investors' sentiment. The banking sector index lost 0.77% last week. It is crucial for the banks to carefully manage their foreign exchange exposure and tax planning to mitigate the impact on their overall financial performance. The Nigerian digital currency e-Naira makes up less than 1% of the total currency in circulation as of March 2024, almost 3 years after it was launched, according to data from the Quarterly Statistical Bulletin of the Central Bank of Nigeria for the first quarter of 2024. Out of 3.87 trillion naira currency by March 2024, e-Naira made up 13.98 billion naira. Let's take a quick short break. We'll be right back. Don't go away. If you're just joining us, it's Business Point, where we extract the Nigerian economy and the government policies. Still on the Central Bank of Nigeria for the first quarter of 2024, out of 3.87 trillion currency in circulation by March 2024, e-Naira made up of 13.98 billion naira. This means that about 0.36% of currency in circulation in the country is in the CBDC e-Naira. However, the amount of e-Naira available for the circulation has surged by 1,896% from 700.75 million naira recorded in October 2021. United Capital PLC was the top gainer in NGX for the week ending July 19, 2024, with the share price appreciating by 42.78% to close the week at 40.55 naira. There was a heightened in United. Actually, the companies announced it was going to pay interim dividends of July. In the week in July 19, 2024, the NGX posted a 0.87% to reach an all-share index of 100,539.4 points. Let's take a quick short break. We'll be right back. Don't go away. Hello and welcome to Business Report. The Central Bank of Nigeria has reported a 39% increase in inflow through international money transfer operators for the first quarter of 2024, compared to the same period in 2023. This is according to data from the quarterly statistical bulletin of the CBN for the first quarter of 2024. Recent reform implemented by the CBN aimed at attracting more dollar supply through IMTOs seems to have triggered the increase. In January 2024, inflow stood at $383.04 million, a significant rise of 30% from $295.21 million in January 2023. This upward trend continued in February, with inflow reaching $322.83 million, representing 65% increase from $195.23 million in February 2023. March saw inflow of $363.70 million, reflecting a 30% rise from the $279.79 million recorded in March of the previous year. The total inflow for the first quarter of 2024 amounted to $1.07 billion, marking a 39% increase from the $770.23 million recorded in the same period of 2023. When comparing first quarter 2024 to the last quarter of 2023, which saw total inflow of $965.82 million, there is an increase of about 11%. Debt service costs have consumed about 74% of the federal government's retained revenue in the first quarter of 2024. This is according to the latest quarterly statistical bulletin from the Central Bank of Nigeria. In the first quarter 2024, the federal government had retained revenue of 1.76 trillion naira. However, in the same period, debt servicing gulped 1.31 trillion naira, which is about 74% of the government's revenue. This figure highlights the continuing financial strain on the government's resources as it grapples with significant debt obligations. There was a decrease in government expenditure by 12.9% from 5.28 trillion naira in the first quarter of 2023 to 4.59 trillion naira by 2024. Also, a decrease in fiscal deficit by 29% from 3.96 trillion naira in the first quarter of last year to 2.83 trillion naira in the same period this year. There was also a decrease in debt servicing spending by 33.5% from 1.97 trillion naira in the first quarter of 2023, as debt servicing to revenue ratio was 149% in the first quarter of last year. Although there was a reduction in the ratio this year, the higher percentage still shows the critical challenge of managing the country's debt in a sustainable manner. A substantial portion of the revenue are directed towards servicing existing debt rather than development projects. The federal government spends more on debt servicing than it spends on personal costs or capital expenditure. Personal cost for first quarter 2024 amounted to 1.15 trillion naira, an increase of 17.1% from 978.11 billion naira spent in the same period last year. However, capital expenditure fell by 39.9% to 1.15 trillion naira in the first quarter of 2024 from the 1.8 trillion naira recorded in the same quarter of 2023. This reduction in capital expenditure is concerning as it suggests a cutback in investment, infrastructure, and other long-term development projects. Capital expenditure is crucial for economic growth and development, and sustained reduction in this area could impede progress and affect the overall economic health of the nation. In the wake of multiple interest rate hikes by the Central Bank of Nigeria, the cost of borrowing has surged considerably, prompting Nigerian corporates to shy away from the capital market. Between January and May 2024, the CBN raised the monetary policy rate by staggering 750 basis points to 26.25%, significantly impacting the cost of capital for businesses as well as governments. Interest rate hikes have been part of the CBN strategy to combat rising inflation and stabilize the national currency, which is currently at record high. Notably, Nigeria inflation rate surged at 34.19% over 28 years in June 2024, while the Naira currently trades over 1,500 Naira against the US dollar. However, this aggressive monetary policy has led to higher borrowing costs for corporates, mirroring the surge in government securities. As a result, companies have adopted a cautious stance towards participating in capital markets. The repercussions of this cautioned approach are evident in the declining figure for new listing of commercial papers and corporate bonds. Data from FMDQ reveals that in the first 5 months of 2024, new listing of commercial papers dropped by 26.6% from 843.62 billion naira in the corresponding period of 2023 to 653.1 billion naira. This significant decline reflects the increased cost of financing, which has deterred companies from seeking short-term debt instruments. Kike Lomo Okeri, Global Television News. Welcome back. If you're just joining us, this is Business Point, where we extract the Nigerian economy and the government policies. Investors are seen locking their money into longer dated bonds rather than short-term high-yielding securities due to the expected slow pace of inflation. Analyst at Cardinal Stone says in their Media Outlook report, says Nigerian fixed income market is expected to see moderation in yields and warns that while current yields are enticing, the inflation effect makes longer dated bonds more sensible. Inflation looks set to dip on the impact of the high base effect starting from the second half of 2024. They recommended a tilt towards long duration and a calculated moderation of short duration. A combination of the factors clearly favors a longer duration fixed income strategy with a careful watch on reinvestment risk linked with currently attractive short-dated fixed income instruments. They noted that the fixed income yield are high and probably unsustainable, adding that the exchange rates look relatively stable versus the first quarter of 2024. The analyst says fixed income investors should be mindful not to fixate on currently elevated effective yields on treasury bills at the expense of locking down north of 20% annual interest rates on the government bond for an extended period. In the first half of 2024, Nigerian fixed income market experienced a significant rise in yield driven primarily by the Central Bank of Nigeria efforts to combat inflation and tightening liquidity through the interest rate. This led to the tighter credit condition and a higher yield on Nigerian treasury bills and bonds. The significant tightening of this monetary policy led to a sharp increase in interest rates across the yield curve, and with investors demanding higher return on fixed income investments, especially for shorter dated maturity. The fixed income market had average yield on treasury bills and bond at 21.80% and 18.80% the first half of 2024, compared to 11% and 14.17% in the same period of 2023, respectively. The alignment in treasury bill rates with the monetary policy rate foreign portfolio investment worth $4 billion year to date trickled into the Nigerian debt capital market. Similarly, analysts at Meristem in their recent report says the yields on the fixed income will hover around current level owing to the countering impact of the monetary authority price stability objective and the need for the government to moderate its borrowing costs. Meristem analysts forecast that foreign portfolio investment inflow and other investments are expected to remain high and result in the highest total capital inflow recorded in 4 years. Meristem recommends that investors should adopt a long-duration strategy in 2024 to capitalize on the current high yield in long-term dated government instruments such as bonds. Also, analysts at CSL Stockbrokers Limited anticipated a moderation in the general yield curve for the Nigerian fixed income market in the second half of 2024. The Debt Management Office is under less pressure to raise funds, having already secured over 12 trillion naira of the estimated 20 trillion naira projected for the debt market this year. As inflation continues to rise high, analysts forecast a mild rate hike at the Monetary Policy Committee meeting scheduled to hold today, while Naira heads to 1,600 Naira after a week of stability. The 296th meeting of the Monetary Policy Committee is scheduled to hold today. All right, this is where we draw the curtain on Business Point today. Join me again tomorrow for another edition. We are on Start Time channel 276 and 365 on DSTV. Kindly follow us on all our social media handles at Global TV NG and website globaltvabuja.com. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.